Joining me now to discuss is OSAIC Chief Market Strategist, Phil Blancato. Phil, nice to see you.
Nice to see you
I mean, this is just a regional New York number, but I mean, look at how it outperforms. This is your best number in 5 years.
Yeah.
What is this telling you about what the Fed could do because of the economy?
I still think the Fed is on pause simply because the latest amount of CPI data and the jobs data and retail spending were a little soft. But I want everybody to think about, on this show for quite a big long time now, we've talked about this renaissance in U.S. manufacturing. And you saw it in Philadelphia, you saw it in Chicago, you're seeing it nationwide, ISM services. So this is indicative of an economy that has an undercurrent of a resurgence in an area that we haven't talked about in maybe decades. And you're starting to see this $2 trillion infrastructure play because of AI come to life, and whether it's new data centers or all the other. Look at how you opened your show. Those aren't AI names. Those are names that are impacted by AI. Corning, a great name. So I think this is indicative of how strong the undercurrent is, but it doesn't mean the Fed's ready to hike rates.
Does that mean the AI trade is bulletproof?
I don't think it's bulletproof because at some point the $5.5 trillion that's going to be spent in total by 2030 has to produce revenue. Now, will we produce enough revenue to make up for that kind of spend? That's yet to be seen. But the reality is the productivity enhancements are so powerful. We just don't understand what it means for long-term productivity growth. We're seeing it now in margin growth. Think about margins, 15% on the S&P right now. On the AI sector, 20, 25%, incredible numbers.
Was it SanDisk that posted 80% margins?
And those are little
80%. That can't be sustainable.
Micron has a PE of 10 if you really look at it honestly. And you're right, the sustainability is the hard part, but the question is the juice worth the squeeze?
Is it?
I think so. As of now, it is. We have to be careful about this open AI, these weighted models, and what it might do. Think about customizing an AI model just for yourself, almost. That's
I'm trying to do that. I'm too cheap to pay, though.
Well, I understand. I mean, it's happening, but that's the impact of productivity. How fast, how much better will we be at things? Ultimately, it translates to a new manufacturing renaissance, an industrial revolution, and for now, the juice is worth the squeeze.
I'm loving the optimism. I don't want to rain on the parade here, but you say the rate hike the market is pricing in. I think there's a 32% chance of a rate hike when the Fed meets in 30 days. Do you see a rate hike?
I don't. And the reason why I just don't see it, maybe if in fact, obviously the Iran situation is very volatile. If we have this scenario where supplies really run down and we see oil push to 100, 115 again, that's a very different narrative. But we're finding out that whether it's the transponders shut off on the ships as they're sneaking their way through, or Venezuela at an all-time high in production, not even being spoken about. U.S. at an all-time high with the Balkans producing oil again. There's been enough oil on the market to keep the price low enough that that's not your issue. I don't think the Fed hikes at a time when the labor market is okay, about weakened. Retail sales are okay, if not a bit softer, and at a time when there's not a real demand for loan growth, so I don't think there's a need for hike right here.
Okay, talk to me about the consumer. Consumer, clearly, how we say we feel about the economy is affected by the price of gasoline. I noted earlier, $4.06 a gallon today. We have a slew of retail earnings coming out this week. Walmart, the big one, goes on Thursday. What are your expectations for the consumer, and is it completely an energy gas price story?
It's not a gas price story.
At all?
It's not. Here's the dirty secret about gas. Folks who make less than $100,000 a year spend about 400. We use about 400 gallons of gasoline a year. Folks who make more than 250 use about 1,000 gallons. So the people who drive the most make the most. It's not that big of a story. It's much more a story towards the end of the year, sort of spurs pricing when you're buying for a holiday season. That's a little different there. For now, I don't see that as the problem. Your problem is things like car insurance, energy costs. Food, by the way, most food is either flat or down year over year. So I don't know that the issue with the consumer is about the current price of things. We've sustained and hung on. Your issue with the consumer is sentiment low, always been low this time of year going into midterms. Sentiment doesn't mean bad for markets. By the way, low sentiment means a great time to buy, generally. Yeah, speaking of AI sentiment, we can't ignore what's on the screen right here. Big tech spending continues to stay in focus. So the Wall Street Journal put out a report stating that big tech's AI spending is, are you ready for this? $3 trillion higher than it seems. This is some of the breakdown here. Because it's not only the CapEx that they're saying they're going to spend this year, it's the dark green, it's these lines, it's the off-balance sheet obligations. Is this a good thing or a bad thing? It's a good thing, and that's why back to my $5.5 trillion by 2030. All these numbers, if you think about this green here, all these down, as you go down, you have to argue, will this spend spur the picks and shovels into other industries. And yes, whether it's Corning or GM or, I'm sorry, Cummins or Caterpillar, excuse me, all those names are indicative of this overspend. The question is, can the Mag 7 still be magnificent when they spent this much money? And as of now, look at the last year, flat. Up, not the contributors that they've been. Will they be going forward? Well, it's really hard to make a $4 trillion company an $8 trillion company. But at the same token, they have the horsepower and the money, NVIDIA, to be able to spend and drive it forward. My argument is we should leave behind the idea of 30% earnings growth. That's silly. But what if they do 8 and 10s and give us margin growth of 8 or 9? That's a solid scenario where we go past this euphoria of spending to normal.
So then they're not growth stocks. They're value stocks.
Look how many have switched over to the value index. Look at Apple on the value index. Look at how many Microsoft on the value index because they become normal.
What about Anthropic? They're forecasting a near $200 billion in revenue by 2028. I mean, it rose 14-fold as they pitched themselves to investors since last year. I mean, what does that tell you about valuations?
The juice is worth the squeeze. Again, that's the first company, the leader in Anthropic, that's clearly saying we are making money. And they're finding ways to drive revenue. Now, I don't like that there's some concerns about the revenue office. There's some changes in the model that are a little worrisome. But beyond that, you have a scenario where I think you really do have an opportunity, Anthropic being the bellwether.
Let's move through these quickly. Goldman Sachs, why do you like it?
The investment banking revenue is killing it, trading cheaper than JP Morgan and more importantly, Morgan Stanley. When you look at what they're doing from a growth story, they have a 34% return on revenue this year. Looking at equity growth, margin growth of probably 15 to 16%. It's a great, cheap, big bank.
Howmet Aerospace, jet engines, people are traveling?
$17 billion in backlog. How do you not buy the company when they're in high demand? They have 40% earnings growth over the next 12 months.
$17 billion in backlog? And what about EMCOR Group? I had never heard of it until you.
Well, I like this stock. Look, at the heart of it all, picks and shovels of AI. They make the power, they create the power, they build a data center, and they're relatively cheap. And you're also talking about another almost 30% earnings growth over the next 12 months.
Phil, you're awesome. Thank you.
Thank you.
Good to see you.